The buzz in our cities is palpable. It's the hum of scooters, the whir of electric bikes, and the silent efficiency of countless deliveries.
Hmm.
But we're not just talking about dinner anymore, are we?
Not at all.
We're talking about getting groceries, maybe a forgotten phone charger, or even vital pharmaceuticals delivered right to your door in, like a flash.
Yeah, it's instant everything almost.
This isn't just a convenience. It feels like a fundamental shift in how we live and shop, especially in urban centers.
It really does. It's changing expectations.
Today, we're plunging into the world of Delivery Hero. Now, this is a company that's been a force in this space since, 2011? Went public in 2017?
That's right. A veteran, really, in this relatively young industry.
They've long been a colossal player in food delivery. We all know that. But their true mission now seems to be conquering the even more dynamic, lightning-fast realm of quick commerce.
Exactly. Q-commerce. That's the new frontier they're really pushing hard into.
So, our mission on this deep dive is to truly unpack Delivery Hero's fascinating journey. We'll look at its foundational, aggressive acquisition strategy that built its empire,
The early days.
to its pivotal and strategic leap into quick commerce. And crucially, we'll examine how their latest financial results from the first half of 2025 reflect these bold strategic adjustments.
Yeah, see how the strategy is actually playing out on the bottom line.
Right, showcasing their resilience in what is, let's face it, an incredibly competitive and ever-evolving market.
Definitely dynamic. Things change fast.
To guide us through this intricate story, we're drawing insights from two essential sources today. First, we have an insightful NetGuru article from March 2025. It details Delivery Hero's ambitious strategy to become a quick commerce champion.
Right. Focusing on that strategic intent.
And then, providing us with a real-time pulse of their current health, we're diving into their half-year financial report for H1 2025, published just yesterday, August 28th.
So, fresh numbers. Hot off the press.
Exactly. So let's get ready to understand how Delivery Hero is not just riding the quick commerce wave, but maybe actively shaping it.
Sounds good. Let's dive in.
Okay, let's unpack this. Before they were racing to deliver, everything under the sun, how did Delivery Hero become this powerhouse in the food delivery space in the first place?
Right.
It wasn't by taking small, cautious steps, was it? Their rise seems, almost unprecedented.
You're absolutely right to focus on their origins because it really does set the stage for everything to follow.
Okay.
From its very inception, Delivery Hero's strategy was less about cautious steps.
Yeah.
And much more about a full-throttle land grab.
A land grab, yeah.
Their mantra was simple, yet incredibly aggressive. Acquire capital, then acquire company.
Right, fuel the machine.
Exactly. This relentless, almost singular pursuit of market share, even at the clear expense of immediate profitability, absolutely defined its early years. They weren't just thinking about the next quarter's earnings. They were playing a much longer, higher-stakes game for global dominance.
So profit wasn't the main driver back then.
Not at all. To give you a real sense of the strategy, look at some of their early financial figures. Their revenue, it dramatically increased from $687 million in 2018 to a staggering $2.8 billion in 2020.
Wow, that's huge growth.
Explosive growth, right? Shows they were gaining immense traction. But simultaneously, if you look at their adjusted EBITDA,
The profitability measure?
yeah, tells a different part of the story. It declined from a negative $100 million to a negative $568 million in that very same period.
So losing more money even as they grew bigger?
Precisely. But the core insight here is that this wasn't an accident. It was a deliberate revenue-first approach.
A strategic choice.
A strategic choice to invest heavily in expansion, betting that once they had secured critical mass and market leadership in various geographies, profitability would, naturally follow. They were effectively buying market share on credit, confident in their long-term vision.
Right. Build the kingdom first, worry about the treasury later.
Something like that, yeah. And this approach, it manifested as an aggressive acquisition spree. We're talking 28 acquisitions over time, which truly staked their claim across the globe.
28.
Yeah. These weren't just small tuck-ins. They were strategic moves to build an unshakable presence. For instance, the acquisition of Foodora in 2015,
Okay.
that was instrumental for their initial expansion across key markets in Europe, North America, and Asia.
Got it.
Then, just a year later, in 2016, the purchase of Foodpanda significantly boosted their market reach, adding 20 new countries across regions like MENA, Eastern Europe, and Asia.
20 new countries in one go.
Yeah, massive expansion. These were astute, large-scale plays that allowed them to rapidly gain strength and scale in incredibly diverse geographical locations,
Mm.
quickly becoming a world leader in food delivery. They essentially bought their way to the top, leveraging strategic consolidation.
That's a lot of companies to bring into the fold. It sounds less like typical growth and more like, I don't know, a carefully executed corporate chess game. Sacrificing short-term profit was just part of the plan.
It really seems that way.
But beyond just sheer size, which is impressive, what did this strategy mean for their actual competitive edge? Because being big is one thing, but being better, that's different, especially with so much competition.
You've hit on a crucial distinction there. Their strategy built a multifaceted competitive advantage that went far beyond mere scale.
Okay, how so?
Firstly, they truly saw technology and innovation as a core differentiator. They pioneered this model of rigorously testing new features, operational tweaks in one country, like a living laboratory for urban logistics.
Right, test locally.
Yeah, and if a feature proved successful, rapid global implementation was the norm.
Roll it out everywhere.
Exactly. Imagine them rolling out new payment methods, refining marketing strategies, or introducing product improvements globally, all backed by data from that localized testing. It allowed them to iterate quickly and maintain a critical technological lead.
Constantly refining things.
Constantly. Secondly, they mastered what's known as globalization.
Localization. Global, but local.
Precisely. This isn't just about translating an app. It's about deeply adapting their global offerings to suit the unique preferences, cultural nuances, even local dietary habits of consumers in different cities.
Yeah, ordering in Berlin is very different from ordering in Bangkok.
Totally different. Trying to offer the same thing everywhere just wouldn't work. This deep market understanding, combined with their global scale, allowed them to integrate deeply into diverse markets. That's fundamentally vital in such a consumer-facing industry.
Makes sense. Local relevance is key.
Absolutely. Interestingly, though, despite all this global prowess, it hasn't always been smooth sailing, particularly in their home market, Germany.
Oh, what happened there?
Well, Delivery Hero actually struggled to thrive in Germany. They pulled out twice in 3 years.
Twice. Wow.
Yeah. Most recently, they announced a return in May 2021, only to withdraw again by December 2021.
Why couldn't they make it work at home?
The reasons they cited were intensified local competition, rising rider costs, and increasingly expensive capital.
So even the giants face local pressure.
Exactly. The core insight here is that even a global giant like Delivery Hero isn't immune to intense, localized competitive pressures and operational challenges. And this struggle in their home turf also kind of foreshadows some of the ongoing challenges we'll discuss later, especially around costs and regulations.
Right. Okay, so that foundational strategy, aggressive acquisitions, tech-driven globalization, clearly built the bedrock for their empire. But as we often see, once you've conquered one frontier, the question becomes, what's next?
The next big leap.
And for Delivery Hero, that answer was the lightning-fast world of quick commerce. How did they jump from delivering dinner to delivering, well, almost anything instantly?
Well, the jump to quick commerce was, in many ways, a natural evolution for them, a logical next step leveraging their existing strengths.
Building on what they had.
Exactly. They entered the market in 2019, recognizing it as a direct extension of their capabilities. Think about it. They had already become experts in complex urban logistics.
Right. Moving stuff around cities efficiently.
And they were at the forefront of technology development in Europe, covering intricate processes like supply chain management, delivery infrastructure, sophisticated marketing. They had built the digital pipes and the physical networks.
So they had the foundation already.
They really did.
Yeah.
And they leveraged this existing expertise extensively. Their advanced logistics algorithms are a critical component here.
More than just GPS, I assume.
Oh, much more. Think of it like a hyper-efficient air traffic controller for every rider and order, constantly recalculating the fastest route based on real-time geolocation data, traffic, rider availability, even what's in your shopping basket.
Wow. Complex stuff.
Very. This is coupled with real-time inventory management, which is fundamental for smooth operations in such a fast-paced environment, often backed by machine learning to predict demand and manage stock across multiple locations.
Predicting what people will want where.
Exactly. And they are masters of data-driven optimization, conducting hundreds of A/B tests daily across all their brands to constantly refine their offering and user experience.
Testing everything.
Constantly. And this data also fuels their technology-driven pricing strategies, always aiming to maximize affordability for consumers while maintaining a sustainable business. Imagine this sheer complexity, right? optimizing routes for dozens of different orders coming in simultaneously.
Yeah, making sure fresh stuff arrives fresh, meds arrive quickly.
Exactly. That's the power of their machine learning at work, handling millions of variables every single day.
Incredible.
Furthermore, they invested heavily in strategic infrastructure and partnerships. This truly sets them apart. A crucial part of this is their network of D-Marts.
D-Marts, dark stores, right.
Exactly, they're dark stores. They operate over 1,000 of these strategically located mini warehouses, optimized specifically for rapid delivery.
1,000. That's a huge network.
It is, and these D-Marts are absolutely crucial for reaching customers faster, with less friction. They act as distribution hubs solely dedicated to quick deliveries, not open to the public. This proprietary infrastructure gives them a massive advantage in speed and efficiency.
Owning the infrastructure.
Right. And alongside this, they've cultivated a vast vendor network, acting as a digital partner to over 80,000 vendors.
80,000 vendors, so lots of choice.
Huge choice. This allows them to offer a truly diversified range of products, spanning traditional groceries, household goods, electronics, flowers, even pharmaceuticals, all available 24/7.
Anything, anytime.
Pretty much. This combination of owned infrastructure, the D-Marts, and extensive partnerships allows them to offer an unparalleled range of products with unmatched speed and choice.
So it's not just about getting food anymore. It's about transforming the entire urban shopping experience. Instant gratification for nearly anything.
That's the goal, yeah.
And what's interesting is it sounds like they didn't abandon their initial growth playbook when they moved into Q-commerce. Did their expansion follow the same acquisition-heavy strategy?
You've identified a key pattern there. Yeah, absolutely. Acquisitions remained a central pillar in their strategy to strengthen their position and conquer the burgeoning quick commerce market.
Sticking to what worked.
Exactly. They didn't abandon their proven method, they just applied it to this new frontier. In October 2021, for example, they acquired a minority stake in the European quick commerce unicorn Gorillas.
Ah, yes, Gorillas, big name.
Big name. That deal was worth $235 million. It gave them an immediate foothold and shared expertise in a rapidly growing, highly competitive segment.
Smart move.
In the same month, they further expanded their footprint in Central America and the Caribbean with the acquisition of Hugo's core food delivery and quick commerce verticals, showing interest beyond just Europe.
Expanding geographically, too.
And one of their most significant moves in this area was upping their stake in the Spanish company Glovo.
Glovo, right, another major player.
Huge player. This made Delivery Hero a majority shareholder in a deal expected to close in Q2 2022. Glovo itself holds a leading position in 16 of the 25 markets it operates in.
So buying significant market share again.
Exactly. The core insight from these moves is a clear, continued commitment to dominating through strategic consolidation. Rather than building everything from scratch everywhere, they quickly bought into or strengthened positions in key quick commerce markets, leveraging existing successful local operations to scale globally.
It's an acceleration strategy.
Pure and simple, buy your way in, scale fast.
This aggressive expansion and strategic investment has definitely put them in a very strong market position. But, as we discussed earlier, that rapid expansion often comes with a financial cost.
Always does.
How is all of this translating into their bottom line now? Let's turn to their most recent financial snapshot, H1 2025, the real-time pulse of their financial health.
Right, let's look at the numbers.
All right, the stage is set. We've traced Delivery Hero's historical path aggressive expansion, the strategic pivot into quick commerce. Now, for the numbers. The latest pulse, first half of 2025. You mentioned a significant shift in their profitability earlier, which is, well, quite intriguing given their past growth over profit mantra. What are the top-line results telling us about this transformation?
You're right to highlight the shift. H1 2025 shows a clear advancement on their strategic trajectory. They're demonstrating a focused approach now to balancing growth, profitability, and cash flow generation.
A balancing act.
It really is. It's a noticeable and intentional shift in focus from their earlier years. It signals a maturing business model.
Okay, so what did the group performance look like overall?
Looking at the overall group performance, we see their gross merchandise value, or GMV, that's the total value of everything bought by customers.
Right, the total throughput.
Yeah. That grew by a solid 3.9% year over year, reaching $24.6 billion. That's up from $23.7 billion in the first half of 2024.
Okay, solid growth.
Solid. But what's important to note is that on a like-for-like basis, meaning if you exclude operations they've exited or sold off.
Comparing apples to apples.
Exactly. That GMV growth was even stronger at 5.8%. This suggests the core ongoing business is performing quite robustly.
Good sign for the underlying health.
Definitely. But the more striking figure, I think, is their total segment revenue. This significantly outpaced GMV growth. It rose by a substantial 18.9% year over year to $7.18 billion.
18.9% revenue growth. That's much faster than GMV.
Much faster. And this acceleration in revenue growth is driven by several strategic initiatives. They're seeing the continued strategic rollout of their own delivery services in key regions.
Taking more control of the delivery itself.
Right, and accelerating order frequency from their loyal customers and a higher contribution from their integrated verticals, essentially, their DMarts.
The quick commerce side kicking in.
They're also increasing consumer fees like service fees, and there's a healthy expansion of non-commission revenue streams, particularly from advertising.
Diversifying income, ads, subscriptions.
Exactly. Additionally, their scaling of subscription models is adding to this diversified revenue base. The core insight here is that this robust revenue growth, significantly outpacing GMV, indicates healthy diversification of income streams and a strong focus on capturing more value from each transaction.
Getting more revenue per order.
Basically, yes. Rather than just relying on sheer volume, they're getting smarter about monetizing their user base and infrastructure.
So revenue is up, and diversifying, that's a positive sign of a more mature business. But the real aha moment here, I think, has to be around profitability.
Right. The bottom line.
For a company that once openly prioritized revenue over profit, almost like a badge of honor for aggressive market capture, what are the latest figures telling us? Is that long game finally starting to pay off?
This is truly where Delivery Hero's strategic adjustments are bearing significant fruit. It demonstrates a remarkable turn towards financial discipline and operational efficiency.
Okay, lay it on us. Adjusted EBITDA.
Let's look at adjusted EBITDA earnings before interest, taxes, depreciation, and amortization. It's a key measure of operational profitability.
Got it.
This figure saw a dramatic improvement, increased by a substantial 70.8% year over year, reaching $410.7 million in H1 2025. That's a huge leap from $240.5 million at H1 2024.
70% increase. Wow.
Huge jump. Consequently, their adjusted EBITDA GMV margin expanded significantly from 1.0% in H1 2024 to 1.7% in H1 2025.
So making more profit per euro of sales.
Exactly, generating more profit for every euro flowing through the platform.
What drove that big improvement?
Well, it was driven by a strong positive contribution from their core platform business that added an extra $113.7 million year over year. And equally significant, their integrated vertical segment, where the DMarts operate.
The quick commerce engine.
Right. That saw its negative adjusted EBITDA significantly improve. Losses reduced from negative $73.8 million to negative $17.3 million year over year.
So the DMarts are becoming much less of a drag.
Much less. That's a critical insight. Their dark store operations are becoming much more efficient, much closer to break even, showing progress towards scale.
That's important for the Q-commerce strategy.
Absolutely vital. It's important to note, however, that this impressive performance was somewhat softened by adverse exchange rate effects, notably from the weakening South Korean won.
The joys of global business. Currency headwinds.
Always a factor. But perhaps the most historic milestone here is their operating result.
Okay.
Delivery Hero achieved its first ever positive operating result, reaching €4.7 in H1 2025.
First ever? That is a milestone.
It's a monumental shift from an operating loss of negative $390.5 million in H1 2024.
From minus $390 million to plus $4.7 million.
Exactly. Moving from deep operational losses to generating a positive operating profit is a clear, undeniable indicator of successful cost optimization and revenue efficiency across the entire organization. It marks a true turning point.
A really significant moment for them.
Definitely. Finally, looking at their net result, while it's still a loss.
Okay. Not quite net profitable yet.
Not yet, but it showed a significant improvement. The net loss reduced by 50.5% year over year, shrinking to negative $356.3 million from negative $720.2 million in H1 2024.
Having the net loss is still pretty good progress.
It's substantial improvement, yeah. It indicates a much healthier underlying business trajectory. This is a company actively moving away from its growth at all costs past.
That's a massive turnaround. Achieving their first positive operating result is huge, implies a much stronger underlying business. Less reliant on external funding, presumably.
That's the goal, yeah. financial sustainability.
But with all this growth and strategic maneuvering, what does their cash flow situation look like? Because profit on paper is one thing, but actual cash in the bank,
Hmm.
that's what keeps the lights on.
Absolutely, cash flow is paramount. And it also shows positive momentum, though with some notable complexities worth understanding.
Okay.
Their cash flow from operating activities significantly improved to $395.4 million in H1 2025. That's a considerable jump from $103.2 million in H1 2024.
Big improvement in operating cash flow.
Huge. This improvement primarily reflects the overall focus on profitability and the resulting performance enhancements across their segments.
But you mentioned complexities.
Yes. A key contributor to this improved operating cash flow was a substantial $211.9 million breakup fee they received in April 2025.
Ah, the Taiwan deal falling through.
Exactly. Following the termination of the sale of Foodpanda Taiwan to Uber, which was prohibited by the Taiwan Fair Trade Commission, well, it's a one-off,
A nice one-off to get.
definitely provided a welcome boost to their liquidity,
Right.
but it illustrates how external factors can swing these numbers quite a bit.
Right. So what about the underlying cash flow without that breakup fee?
Good question. When we look at free cash flow before extraordinary items, it stood at negative $7.7 million for H1 2025.
Negative 7.7 million, so almost break even.
Very close. While still negative, this is a significant improvement from previous periods, showing a near break-even on an underlying basis.
Explain that extraordinary items part again.
Right. Think of it this way. If you take out the one-off windfall from, say, that breakup fee, and you also take out potentially massive one-off costs, like settling a big lawsuit.
Okay, stripping out the unusual stuff.
Exactly. Is your actual day-to-day business making or losing cash? For Delivery Hero, that underlying picture is almost breaking even, which is huge progress towards sustained financial health.
Shows they can nearly fund their operations internally now.
It's a critical step, yeah, a very positive sign.
These top-line financial improvements are striking, a company truly transforming its financial profile. Now, let's drill down into how each of their diverse regions and business segments contributed to this overall picture.
Good idea.
It's such a globally diversified company, so I'm keen to understand the individual stories behind these big numbers.
You've hit on a crucial point. Their global diversification means each region tells a slightly different story, reflecting unique market conditions, competitive landscapes, and local strategic priorities.
One size doesn't fit all.
Definitely not. This highlights Delivery Hero's adaptable region-specific strategies, often prioritizing long-term market health over uniform short-term gains.
Okay, let's start with Asia. It's their biggest segment by GMV.
That's right. Asia accounts for 43% of the group's total GMV. Here, the picture is a bit mixed. GMV actually saw a decline of 10.4% year over year,
A decline. Why was that?
primarily due to intensified competitive pressure in South Korea, which is a huge market for them, and significant negative foreign exchange effects from the weakening South Korean won.
Competition and currency woes.
Exactly. But the core insight here is how Delivery Hero responded. They aggressively expanded the availability and improved their own delivery services.
Doubling down on their own logistics.
Yeah, boosting their share from 52% to a remarkable 69%. They've also introduced attractive subscription offerings and continuous app improvements.
Fighting back strategically.
Key events included acquiring selected assets from Deliveroo Hong Kong to gain market share, and that terminated sale of Foodpanda Taiwan to Uber, which, as we mentioned, resulted in that $211.9 million Tramit breakup fee.
Right, the silver lining.
But here's the interesting part. Despite the GMV decline, Asia's segment revenue actually increased by 10.5%.
Revenue up, even with GMV down. How?
And adjusted EBITDA grew by 12.4% to $176.3 million. This profit improvement was driven by logistics optimization, lower delivery cost per order, and reduced marketing spend.
So focusing on efficiency and profitability over pure volume in Asia.
Exactly. What this tells us is that Asia is aggressively optimizing for profit, despite declining GMV. It shows a strategic pivot towards efficiency in a tough, competitive market.
Interesting. Okay, what about MENA? Middle East and North Africa.
Moving to MENA, which represents 29.4% of group GMV, we see a story of strong, balanced growth, very different from Asia.
How strong?
GMV increased by a robust 22.4%, segment revenue by 22.1%, and adjusted EBITDA by 22.1%, reaching $256.2 million. Growth across the board.
Nice. What fueled that?
The growth here was fueled by a substantial expansion of the customer base, further scaling their own delivery services to nearly 80% share.
High penetration of own delivery there.
Very high. and appealing offers, including attractive subscription plans and meal-for-one options, strengthening vendor partnerships, and improving product availability through multi-vertical strategies like quick commerce.
So a combination of factors driving growth.
Yeah. Financially, revenue and EBITDA were boosted by strong customer demand, diversified revenue streams including their ad tech products, and effective cost management, like fleet optimization.
Okay. MENA looks healthy. What about Europe?
The Europe segment, making up 19.5% of group GMV, saw GMV grow by 11.6%, and segment revenue surged by 29.7%. Pretty strong top-line growth.
Revenue growth outpacing GMV again.
Right. However, Europe's adjusted EBITDA declined by 28.6%, resulting in a negative $50.8 million.
So profitability went the wrong way in Europe. Why?
The growth was driven by increased customer base, order frequency, and more own delivery services. But the key challenge and the main reason for the negative EBITDA was primarily due to increased delivery costs associated with the transition to an employment-based rider model in Spain.
The rider reclassification issue hitting the books.
Exactly. This highlights a crucial point. Europe is taking a short-term hit on profitability due to significant regulatory shifts around gig economy workers. It's a challenge we'll explore more deeply later, but you see the direct financial impact here.
Got it. A major headwind in Europe. How about the Americas?
Our fourth region, the Americas, holds 8.0% of the group's GMV and demonstrated robust growth. GMV was up by 20.9% and segment revenue by 18.3%.
Strong growth there too, and profitability.
This is the standout. Most notably, adjusted EBITDA saw a dramatic improvement. It swung from a negative of $12.9 million to a positive plus $46.2 million.
Wow, from loss to solid profit. A big turnaround.
A more than 100% change, yeah. Solidifying its profitability trajectory. This was driven by elevated customer demand, an expanded active customer base, increased order frequency, supported by strategic focus on customer acquisition and retention via expanded subscription programs.
Subscriptions helping there.
And the growing penetration of quick commerce also led to larger basket sizes and enhanced user retention through multi-verticality.
Q-commerce paying off in the Americas.
Seems so. Revenue growth was further boosted by strong penetration of ad tech products, and efficient cost management played a key role in boosting margins. Their own delivery share here is an impressive 95.9%.
Almost entirely their own riders. Okay.
Finally, the integrated vertical segment, that's mainly the DMarts, the quick commerce infrastructure.
Right. How are they doing? Still losing money.
They showed strong progress. GMV grew by 24.5% and segment revenue by 18.4%.
Yeah.
And importantly, its negative adjusted EBITDA significantly improved by 76.6%.
76% improvement.
Yeah, reducing the loss from negative $3.8 million to negative $17.3 million.
Getting much closer to break even.
Much closer. This segment, as you said, is primarily their own warehouse operations, the DMarts. As of June 30, 2025, they operated 789 DMarts across 48 countries.
Still a big operation.
Huge. The improvement was driven by increasing scale in customer demand, higher order frequency, larger shopping baskets, as well as better assortment and higher utilization of the stores. More orders per store per day.
So the DMart model is becoming increasingly viable.
It definitely indicates that, yes, progress towards profitability there.
It's clear that while the overall trajectory towards profitability is positive, each region really does have its own unique story. Varied success, distinct challenges like regulation in Europe, competition in Asia.
Absolutely. It's a complex global picture.
These regional dynamics, of course, are reflected in the overall cost structure of the company. So let's break down how their spending and revenue composition are evolving. That gives us a clearer picture of their operational strategy.
Sounds good. Let's look under the hood at the costs and revenue streams.
Right. The half-year report gives us that detail, doesn't it? Showing how they're managing the internal levers.
Absolutely. The detailed breakdown really reveals their operational effectiveness and the impact of these strategic shifts. It shows a company actively trying to improve its operating leverage.
Okay, so let's start with revenue composition for H1 2025. You mentioned total segment revenue was up 18.9%, outpacing GMV growth. What were the key components?
Right. That gap between revenue and GMV growth is key. It tells you they're increasing their take rate, the slice they keep, and diversifying income.
Beyond just commissions?
Exactly. While commission revenue remained the largest component, what's really growing are the other categories. Delivery fees increased by 13.5%, driven directly by expanding their own delivery services.
Okay, makes sense.
More impressively, service fees showed remarkable growth, surging to $253.5 million. That's an impressive 90.8% increase year over year.
Wow, nearly doubled service fees.
Yeah. DMart's revenue accounted for $1,367.5 million, up 17.9%, representing nearly 20% of their total revenue. Shows the growing importance of that Q-commerce infrastructure.
Significant chunk now.
Definitely. Advertising and listing fees also grew by 9.1%, reflecting the growing importance of non-commission revenue. And subscription fees saw substantial growth, increasing by 84.6%.
Ads and subscriptions really taking off.
They're becoming vital contributors. The core insight here is a successful diversification of revenue streams beyond just traditional commissions. Service fees, advertising, subscriptions, they make the business model more robust.
Less reliant on just one thing. Okay, what about the cost side? Cost of sales.
Right, onto the costs. Cost of sales increased by 24.5% to $5,145.6 million in H1 2025.
Growing costs, as expected with expansion.
Yes. Delivery expenses dominated this, constituting 68.3% of the total cost of sales. That's primarily driven by the significant rollout of their own delivery services, particularly in Asia.
Running your own delivery isn't cheap.
It's not. The cost of goods sold related to DMarts also increased, reflecting their growing contribution. As a result, the gross profit margin actually decreased slightly to 25.2%.
Margin down slightly. Is that bad?
Well, not necessarily when you look deeper. Crucially, the gross profit to GMV ratio increased by 0.1 percentage points year over year to 7.0%.
Ah, so they're getting more gross profit out of every euro of sales flowing through.
Exactly. So while total costs are rising with expansion, they are achieving improved operational leverage and efficiency in managing the core delivery and DMart's operations. Generating more gross profit relative to GMV, they're getting smarter about the fundamentals.
Better unit economics, essentially.
That's the idea. Now, on the operating expense side, we see some interesting trends in management. Marketing expenses slightly increased by 1.1%.
Okay.
But importantly, the ratio of marketing expenses to GMV improved slightly to 3.0% from 3.1%, suggesting they're becoming more effective and efficient with their marketing spend.
Getting more bang for their marketing buck.
It seems that way. IT expenses, on the other hand, actually decreased by 8.5% to $248.8 million, primarily attributable to expense optimization.
Cutting IT costs while still innovating.
Apparently so. The ratio of IT expenses to GMV also improved slightly, demonstrating successful cost control while maintaining a strong focus on technology and product innovation.
Good discipline there. What about G&A, general and admin?
General administrative G&A expenses saw a significant decrease of 28.3%. A key factor here was a positive $71.0 million income from a partial reversal of an EU antitrust provision following a settlement.
Ah, that settlement helped the G&A line.
It did. Shows how external legal factors can directly impact the financials. Other factors included a slight decrease in personnel expenses. Overall, the G&A to GMV ratio improved even when you adjust to that antitrust effect, showcasing better cost management across the board.
Controlling overheads.
The net interest result declined to a negative $110.5 million, mainly due to amortization of financial liabilities. However, it was positively impacted by gains from convertible bond buybacks. They bought back some debt cheaply, bringing in $29.1 million and interest income on their cash balances.
Okay, managing financing costs.
And lastly, the other financial result dropped to a negative $164.2 million, primarily driven by net losses from the fair value measurement of financial instruments and foreign currency translation losses, highlighting that currency volatility risk again.
Right, global complexities.
So the financial details really illustrate a company actively working to improve its operating leverage. They're finding efficiencies in IT, G&A, while strategically investing in marketing and dealing with the increased costs of their own delivery and DMarts. They're very actively managing and optimizing every aspect of their financial structure.
These financial intricacies are fascinating, showing a real operational transformation, but they don't tell the whole story without looking at the external pressures.
True, the market context is key.
Delivery Hero operates in a dynamic and, let's be honest, often legally challenging environment. Let's explore the regulatory and market hurdles they're actively navigating, because these can significantly impact even the most well-run companies.
You're absolutely right. This industry is often described as a regulatory minefield, and Delivery Hero is certainly feeling the pressure on multiple fronts.
What's the biggest one?
Well, one of the most significant and ongoing challenges is the rider reclassification risk. This is really the battleground for the entire gig economy.
Freelancer versus employee status.
Exactly. The core issue is the legal status of riders. Are they self-employed freelancers or employees.
Mhm.
This is a matter of ongoing dispute, particularly in parts of Europe and Latin America.
We saw the impact in Europe's financials. How are they handling it?
In response to these pressures, Delivery Hero began adapting its rider engagement models in certain European countries in H1 2025,
Hmm.
specifically Italy and Spain.
Changing their model.
Yes, these changes are a direct response to disagreements with local authorities. Their approach involves either strengthening the freelance status where legally possible or transitioning existing freelance models into employment frameworks, often involving third-party logistics providers.
So using third parties for employed riders sometimes.
That seems to be part of the strategy. But this transition, well, it's unprecedented in many markets and introduces temporary risks. Compliance challenges with these third-party providers, even one-off payments to riders who opt not to continue under the new models. It's a massive operational undertaking.
Sounds complex and potentially costly.
Very. And a high-stakes case in this area involves Glovo, their subsidiary, in Spain.
Right. What's happening there specifically?
In July 2025, Glovo began receiving final reclassification decisions from local authorities requesting the payment of substantial liabilities.
Liabilities meaning back payments for Social Security and fines.
Exactly. As of July 31st, 2025, these requests totaled approximately $450.0 million for Social Security liabilities and fines.
450 million euros. Just for Spain.
Just the requests received by that date for Glovo Spain. The broader rider reclassification-related contingencies for the entire group range between $562.0 million and $923.0 million, with a significant portion directly related to Spain.
Huge potential liability. What's the company's stance?
Delivery Hero's assessment is that reclassification of the courier fleet is not probable. Glovo plans to actively defend the self-employed status through all available legal instances.
So they're fighting it.
They are. However, they will meet payment requests in H2 2025 to, keep operating smoothly. But crucially, these payments will be explicitly excluded from free cash flow before extraordinary items, highlighting their exceptional nature.
Treating it as a one-off legal cost, not part of normal operations.
Precisely. The core insight here is this situation underscores the immense regulatory uncertainty and the potential financial impact on the gig economy as a whole. Delivery Hero is taking a firm legal stance while acknowledging the significant financial outflow required.
A major, major challenge. Any other big legal hurdles?
Well, they recently closed a chapter on competition law-related risk. In June 2025, Delivery Hero reached a settlement with the European Commission.
What was that about?
It related to an antitrust investigation initiated back in July 2024. It focused on historical practices involving market allocation, information exchange, and no-poach agreements with Glovo before Delivery Hero acquired them.
Pre-acquisition issues with Glovo?
Right. The outcome was a settlement fine of $329.0 million.
Another big fine.
It is. But interestingly, this fine was actually about 20% lower than the amount they had previously provisioned, $400 million.
So it was less than expected.
Yes, which led to that partial reversal of the provision we saw positively impacting their G&A expenses in H1 2025. This settlement closes a significant legal chapter, allowing them to move forward with a reinforced commitment to compliance.
Okay, putting that behind them. Anything else?
Lastly, they are exposed to transfer pricing disputes. This is a common complexity in the global digital economy.
How companies price transactions between their own international subsidiaries.
Exactly. Operating internationally, especially with new business models and complex structures, inherently exposes companies to audits and disputes with tax authorities about whether those intercompany transactions are valued fairly.
Why is it so complex?
Well, new business models, tax authorities' limited experience, difficulty in quantifying the value of intangible assets, complex structures, limited comparable data. It all adds up. As of June 30, 2025, they're facing over $128.7 million in potential tax liabilities, largely from disputes in the Marseille region.
Another 100 million plus in potential costs.
Yeah. It highlights the ongoing challenge of defining fair value across complex international structures in a rapidly evolving digital landscape.
These are substantial challenges, especially those potential cash outflows for rider reclassification in Spain, hundreds of millions of euros potentially. That's huge.
It really is.
What does their current financial position look like in terms of liquidity? Can they actually withstand these pressures? Do they have enough buffer?
That's the critical question, isn't it? And fortunately, their financial position indicates a strong buffer to navigate these hurdles. Delivery Hero maintains a robust liquidity position.
How much cash do they have?
As of June 30, 2025, they held a substantial cash and cash equivalents balance of 2,808.1 million, nearly 3 billion euros.
Okay, that's a healthy cushion.
It is.
Yeah.
While it was down from 3.8 billion at the start of the year, that was primarily due to active debt management, not operational burn.
Debt management, like paying down debt.
Exactly. In H1 2025, they actively repurchased convertible bonds with a nominal value of 895.9 million. This generated 29.1 million in gains and, more importantly, reduced their future debt obligations, strengthening their balance sheet proactively.
Smart move to reduce debt when you can.
Furthermore, they've extended the maturity of their revolving credit facilities, RCF, basically their big credit line, to May 2028, and they upsized the volume by 240 million, bringing the total available to 840 million.
Secured access to more credit, too.
Right. They also confirmed compliance with key covenants, including maintaining a minimum liquidity level. The core insight here is that their robust cash balance, active debt management like those bond buybacks, and extended credit facilities provide significant financial flexibility and resilience.
Enough firepower to handle these legal and regulatory bumps.
It appears so, which is absolutely essential given the substantial contingencies they face, particularly around rider reclassification. They've built a strong financial fortress.
It's a complex picture. Growth, formidable challenges, and incredibly strategic financial management. But what's the outlook for Delivery Hero as they look ahead? Where do they see themselves going?
Right. What's next?
What can we expect for the rest of 2025 and beyond from this global player?
Well, Delivery Hero has updated its outlook for the full year 2025, reflecting both their progress in the first half and, the dynamic market conditions they face.
Okay, what are they forecasting?
For GMV, they anticipate slight growth above 2024 levels. 2024 was 48.8 billion, so growing slightly on that. They expect total segment revenue to grow faster than GMV, showing moderate increases compared to 2024's 12.8 billion.
Still expecting revenue to outpace GMV.
Yes. Regarding adjusted EBITDA, they still expect significant growth, but the target range has been adjusted slightly downwards.
Lowering the profit target a bit.
A bit. It's now projected to land between 900 million and 940 million. That's down from the initial target of 975 million to 1,025 million.
Still aiming for close to $1 billion in adjusted EBITDA, though.
Oh yeah, still substantial growth. And importantly, they were still aiming for an adjusted EBITDA GMV margin of more than 1.5%. So the focus on profitability per sale remains.
And free cash flow, the underlying cash generation.
Similarly, their free cash flow before extraordinary items has also been adjusted downward slightly to 120 million or slightly above. That's from an initial target of 200 million or slightly above.
Still positive, but less than first hoped.
Right. And again, it's important to remember that this free cash flow figure explicitly excludes those extraordinary cash outflows from legal disputes like Glovo Spain and inflows from M&A breakup fees.
So the underlying business is expected to generate over 120 million in cash.
That's the forecast. The core insight here is that this revised outlook reflects a realistic assessment of the market, acknowledging potential impacts from competition or unforeseen events, while still projecting substantial growth and improved profitability for the year. It's a balance of ambition and pragmatism.
Makes sense. Manage expectations.
Exactly. And the company openly acknowledges that forecasts in a young, rapidly evolving industry like this are subject to considerable uncertainty.
Things can change quickly.
Very quickly. Factors outside their direct control, new competitors, revenue downturns could necessitate adjustments like, needing to suddenly increase marketing spend. This inherent uncertainty is a constant companion in quick commerce. Agility is key.
It's a tough industry to forecast, no doubt, but their strategic focus seems clear. Continued growth, but with a much sharper eye on the bottom line now.
That seems to be the core message, yes.
What about the innovation side? What are they exploring to maintain their edge in this super fast delivery world? Are they investing in the future or just optimizing the present?
Oh, innovation remains a very high priority. It's seen as crucial for driving their long-term competitive advantage.
What kind of things are they looking at?
Delivery Hero is actively exploring ways to expand the use of robotics in their logistics, and even the possibility of using drones for deliveries.
Robots and drones, really?
Yeah. The goals here are twofold. First, to significantly increase delivery speed. That's the holy grail of quick commerce, right?
Faster is always better in this game.
And second, to make rural areas, which are currently difficult and costly to reach, more accessible for their services. These aren't just futuristic ideas. They're seen as essential for scaling efficiently.
expanding reach and cutting costs, potentially.
hmm Beyond the physical delivery mechanisms, they are continuing to leverage artificial intelligence, AI, across their operations.
AI is everywhere now. How are they using it?
Well, it isn't just a buzzword for them. It's an ongoing process that touches pretty much every aspect of their logistics and service, from optimizing inventory and pricing
Okay.
to enhancing the customer experience and reducing operating costs. AI is really foundational to their efficiency, allowing them to constantly refine their operations day by day.
Using data to get smarter all the time.
Exactly. The core insight is that these technological advancements, robotics, drones, AI, are critical for driving efficiency, reducing costs, and expanding their service capabilities. All absolutely essential for maintaining future market leadership in a sector where speed and scale are paramount. They are definitely playing for the long game.
So Delivery Hero is clearly not resting on its laurels. It's an evolving story of strategic adjustments, aggressive technological bets, and skillfully navigating a turbulent, rapidly changing market. Always with an eye on that bottom line now.
That sums it up pretty well, I think. It's a dynamic situation.
What an incredible deep dive. We've seen Delivery Hero transform from that aggressive, acquisition-driven empire builder, prioritizing sheer market share,
The early days, yeah.
to a far more disciplined, tech-forward, quick commerce champion. Their H1 2025 results, fresh off the press, show a company truly turning a corner, achieving that positive operating result for the very first time.
A huge milestone.
They're balancing growth with a strong push towards profitability, all while navigating these significant and complex regulatory and market challenges, from rider reclassification to antitrust investigations.
It's a truly fascinating case study in corporate adaptability and strategic evolution. Their initial strategy, rapid market entry, leveraging tech, smart acquisitions, it positioned them as a world leader in food delivery.
Built that foundation.
Exactly. Now, the shift to a more profitable growth trajectory, even with those necessary adjustments in their 2025 outlook and the significant financial implications of rider reclassification risks, clearly signals a maturing business.
Growing up, in a way.
Yeah. And the ongoing innovation in areas like AI, robotics, drones, it suggests they're looking far beyond current challenges, consistently investing to secure their long-term future in this hyper-competitive space. It's a testament to their dynamic leadership.
So considering Delivery Hero's bold strategy, acquiring, expanding, innovating, even facing these major hurdles, here's a final thought for you, our listener.
Hmm?
How might their commitment to defending riders' self-employment status, despite the multi-million euro liabilities and ongoing legal battles, ultimately shape the future of the entire gig economy? Not just for them, but for countless other platforms worldwide.
That's a huge question. The outcome there could have really far-reaching consequences.
Definitely something to ponder. Thank you for joining us for this deep dive into Delivery Hero. We hope this has given you a shortcut to being well-informed about their journey and future.
Hope it was insightful.
Keep exploring, and we'll catch you next time for another deep dive.